Hey everybody. So I've gotten quite a few questions obviously in the past 24 hours about what's going on in the banking sector with, Silicon Valley Bank, Silvergate, and now Signature Bank all basically going out of business and being placed into receivership. What's going to happen? So what I thought I'd do is take a few minutes to kind of go over what's happened so I can maybe help you better understand the situation and then my thoughts on what's going to happen going forward. So it's been a pretty interesting march in the financial sector, especially the banking sector. In case you haven't been paying attention, we're now up to three large United States banks that have gone out of business and been placed into receivership. Now, that over the weekend created a lot of uncertainty about what's going to happen because we've had Silicon Valley Bank that's now out of business, which is now the second largest bank failure in US history. And Sunday night, we had Signature Bank go out of business, which is now the third largest US bank failure. So let's kind of go through what happened. So first up, earlier this month, Silvergate Bank went out of business. And this was a bank that dealt a lot in the crypto space. And if you've been paying attention over the last year plus, cryptocurrencies have been under a lot of pressure. So long story short, they got caught up in that and they ended up going out of business and being placed into receivership. Now, the big story then that happened basically a week later was that Silicon Valley Bank very quickly ended up going out of business. Now, Silicon Valley Bank is a very unique situation. It does business primarily with venture capitalist tech startups. And the fact is, almost 95% of their deposits at that bank were above the $250,000 FDIC insurance limit. Now, the reason Silicon Valley Bank went out of business was not because they did something excessively crazy risky, which was the type of behavior that led up to the financial crisis in 2007, 2008, but basically they got their duration risk wrong. To put it simply, duration risk is the risk that a bond portfolio has to changes in interest rates. So what they did in an effort to chase higher yield in order to earn more money on their portfolio was that they started investing in longer duration, longer term US Treasury bonds, trying to chase an extra 50 basis points of yield. And what that meant was, especially over the last year where we've had very rapid interest rate rises, that the value of the bonds held on the bank's books diminished in value. Because keep in mind, bond prices and interest rates are inversely related. So if interest rates go up, the price of the bonds go down. But if you hold those bonds until their maturity, if you paid $1,000 for the bonds when you bought them, you're going to get $1,000 back when they mature. So those bonds were on their sheet as a safe asset. However, some venture capitalists last week told their portfolio companies, so the tech startups that they had invested in, that things weren't looking good at Silicon Valley Bank because of this duration risk and that they should go take their money out. And what this basically did was create a $40 billion plus run on the bank in a day. Now, what this did is created a cascading situation where depositors were trying to pull their money out of Silicon Valley Bank, and what they needed to start doing was selling assets that were worth less than they should have been in order to cover those deposits. And to greatly oversimplify things, what it ended up doing was causing the bank to fail. Then, with all the craziness going on with Silicon Valley Bank, it started creating fear and uncertainty and doubt in the financial markets and especially in the banking sector. And what then happened Sunday was people were trying to pull their money out of Signature Bank, and it caused them Sunday night to basically have to go into receivership and go out of business as well. Now, as of last Sunday night, so March 12th, the FDIC, the Federal Reserve, and the Treasury Department have set up certain measures to create a backstop to the banking system in the hopes that that's going to shore up people's confidence to try to prevent any more bank runs. Additionally, on the morning of the 13th, Monday morning, President Biden came out and said that we will do whatever is needed in order to shore up the banking system. So what does this mean going forward? Are we going to have the potential beginnings of another 2008 financial crisis with a bunch of runs on the bank? Well, I don't particularly think so. And that's because there's been a lot less risky behavior going on with the banks. Yes, Silicon Valley Bank screwed up by messing up their risk when it comes to duration. However, they weren't going crazy, guns blazing in the air, throwing all caution to the wind like a lot of the banks were doing prior to the 2008 financial crisis. However, what could happen maybe going forward is this could potentially be the trigger that starts the dominoes going that gets us into the recession people have been predicting for 2023, 2024. It could happen soon, it could happen later. I have no idea. And that's really the thing to take away from this is no one knows what's going to happen. So what should you do going forward? Well, the most important thing is don't panic. If you have less than $250,000, you are still covered by FDIC insurance. Now, will that mean you can't get to your deposits in a timely manner? Maybe, maybe not. However, I don't foresee the collapse of the United States banking sector right now. That's very unlikely.